Okay, why don't we get started? Firstly, and most importantly, thank you very much for coming today. And just in case you thought we'd lost our minds, we have something like 100 people who RSVP'd. I guess a lot of them are either not coming or they registered solely to get the audio video. I should note that it is being video recorded, so don't say anything you wouldn't want your mother to hear. And a couple of administrative announcements before we get going. Just for the format for today, our presentations will not include introduction of speakers. Their bios are all in front of you. Equally in front of you, for those who are interested, are forms for CLE. Certainly, we encourage you, if you want CLE, to fill them out and put them back at the desk at the front, the entrance where you came in. Restrooms you passed on the way here, so just backtrack. And with that, I'm going to get our formal proceedings underway. First panel for today is to discuss legislative initiatives and legal challenges to the risk retention rules. And I'm going to call on my partner, Chad Hoyt, to get us going. And in a minute or two, Chad, could you give us an overview of the risk retention rules just to set context for the rest of today?
Now it is.
Yes, and you need to speak into the mic.
Of course, Paul. Not sure a minute is doable, but we'll give it a shot. So as everyone knows, risk retention rules were passed a couple years ago. They're starting to be implemented this year, first off with RMBS, which is already effective, and the rest of them, which would be effective starting in December 24th of this year. In general, the rules require that the sponsor of a securitization retain at least 5% of the fair value under GAAP as of the closing date of all ABS interests. There are a number of different ways you can meet that 5% test or meet the risk retention rules. One is an eligible vertical interest, which is a strip, all the way up and down the capital structure of the ABS securities. It could be either a single vertical security that is separate from all the rest of the securities that are issued in the ABS, or it could be a vertical portion of each of the capital classes that you guys issue in the securitization. Another option is the eligible horizontal residential or residual interest. That's just a strip at the bottom of the securitization, or a reserve account, which would obviously be a reserve account capitalized with cash or investments in a sufficient amount. And another option is to pick and choose between those different options to create your own specific form of risk retention that meets the test. There are also a number of different specific rules for different types of deals. Examples include RMBS, which has exemptions for both GSE securitizations so long as they're in conservatorship. That's Fannie and Freddie, and exemptions if a securitization has qualified mortgages, QRMs, which are specific types of mortgages that would meet standards in high-level summary, ability to repay, and debt-to-income ratios, et cetera. So far, since RMBS is the one type of securitization that's currently subject to risk retention, there's a little bit of history out there, at least a few months on that. To date, so far, it appears that most people, for reasons that will be discussed later in this panel, are generally doing vertical retention, though there has been perhaps a couple horizontal ones that have been done. With respect to auto loan securitizations, there are a number of public shelves that have been filed. Based on looking at those, it seems like people are generally keeping their options open, and that the base prospectuses describe both horizontal, vertical, and L-shaped interest, and even reserve accounts as possible options that the platform would use to meet risk retention. With respect to credit cards, there's also a revolving pool option in which the seller's retained interest can meet the test. As we'll discuss in the next panel, CMBS also has a B-piece option, whereby rather than the sponsor retaining the interest, the owner of a B-piece buyer, which is kind of the bottom level securitization security, can meet that test. And then CLOs, which we'll also discuss in the next panel, have special rules with respect to what the collateral manager, which is effectively the sponsor in theory, has to do to meet that test.
Thanks very much, Chad. Dave is a partner in one of the world's largest accounting firms and obviously a longtime practitioner in structured finance and securitization markets. I'm sure your clients are calling you. What are you hearing from them about risk retention and their plans regarding risk retention? And just to remind our audience, if you could speak to both new CLOs, which are clearly going to be subject from the rule going forward, as well as legacy CLOs because of the refinancing option, which may trigger risk retention.
Yeah, so there's a couple things that are important here, and really at the end of the day, for the deals that are being done prior to the required date of Christmas Eve of 16 in the CLO markets is where I'm going to focus my answer here. I think when you think about it, or what you see is you see two ends of the spectrum. I saw one CLO that made the disclosure that said we are not risk retention compliant. We don't plan to be risk retention compliant now or in the future. So if you buy the securities, understand that that's our position. It was actually an Ameriprise CLO that was issued last fall. When you think about others and a lot more of the conversations that are happening today, most of those positions are stating that they are today risk retention compliant when the issuance goes out. Or if they're planning issuances this year, they are planning to issue it and be able to say in the OM that it is risk retention compliant. Now, you might ask, why would somebody be interested in being risk retention compliant today when it's not really required? Because you've just told us that the date that they have to be is Christmas Eve of 2016. And the answer is what Paul kind of talked about there. These CLOs can sometimes be repriced at points in time in the future. If the repricing happens post Christmas Eve of 2016, to be able to do that repricing, it's going to have to then be subject to the risk retention rules, as I understand it. And therefore, the importance of being risk retention compliant today, prior to Christmas Eve of 16, would be that if the repricing happens, you're already there. What I don't know, and I've asked my lawyer colleagues at points in time, what happens if a repricing were to happen after that date and it's not risk retention compliant? And the answer that I've received to date, at least, and others can expound on that, is, well, it's not in compliance with the regulations. I said, well, does somebody go to jail for that? Or is there a penalty? Are the securities not tradable? You know, I'm not sure I know exactly what the answer would be at that point, but suffice it to say, nobody wants to answer that question, at least now, and therefore a lot of folks that are issuing the securities today are in a position where they want it to be risk retention compliant before it gets to that point so that they minimize the risk of issues later on if they want to do a repricing. And maybe the answer is they can't do a repricing. So does that help?
Yeah, that's terrific. And we may qualify you as a lawyer yet. Chad, the CLO market in particular has been adversely affected by these requirements for a couple of reasons, including the fact that historically managers haven't put that much investment. They obviously, like all other asset managers, just get a fee for a service. Could you talk in more detail about what the reaction of the CLO industry has been, what they're doing now, and in particular give a little more color on how it affects them adversely?
Great. Well, I think the first question is that the CLO industry asked is, why is this being applied to us? I think they kind of viewed themselves as not squarely in the fairway of securitization like RMBS and CMBS and auto loans, et cetera. Since they're generally not originating product, or they're not originating product and creating their own securitizations, they're really bundling loans that have been originated, by various different, lending banks and other lending institutions, around the nation, around the world. So their view is, we're not really, at least in industry initial views, that this doesn't really seem like this should apply to us. We're also, each CLO has their own independent manager who's looking out for the CLO, et cetera. So it's not, it's not, dealing with its own collateral that it's originated. It doesn't have all these kind of issues with being conflicted or potentially conflicted on what it should do in connection with the transaction and reps and warranties or issues with the underlying collateral, et cetera. So I think the general tenor in the industry was, this is unfortunate that it's happening to us, and it's not, going to really work well for our industry for the reasons Paul mentioned on the amount of, equity or capital that they normally put in at the bottom of the stack to get to that 5%. So I think there's been a couple of responses to this. David, mentioned some where, some people are trying to figure out how it's going to work. Some people are putting their heads in the sand, maybe at least for the next 11 months or 10 months or so now until the end of the year and potential repricings occur. A couple other things that have developed over the last year or so is the LSTA actually filed a lawsuit against the rules, basically, raising some of the issues I raised and some other issues, regarding, that they shouldn't be subject to risk retention. They're not a securitizer. They had some arguments about what credit risk should mean and whether, that's this whole securitization. Is it the equity at the bottom of the CLO? What's the scope of that? Is that really, do we really fall into that bucket? And that some Administrative Procedure Act type claims, such that the agencies were arbitrary by imposing this on us and not thinking about the specific details of the CLO market and how risk retention, if it has to be applied to that market, should be tailored to fit it. That case was filed in the D.C. Court of Appeals for some technical reasons based on it being a little unclear whether there was, what the statutory ambiguity was, and there's certain rules that require that, certain cases get filed up in the Federal Court of Appeals rather than at the District Court. There was a hearing about 2 months ago in February on that case. A fair bit of time was spent on the jurisdictional issue of whether it should be in the appellate court or the district court. I think the decision came down, or is coming down, that they're going to be moved to the district court. So that case is going down there to be further arbitrated. Positive impact on that front is at least the LSTA is trying to get the government to use the same briefs that were filed at the appellate court to speed the process, and they've also waived their right to appeal en banc at the Court of Appeals to try to get it moving quicker, obviously given the time frame of the new rules implementation. So that's sort of where that case is now. It's hard to obviously handicap how and when litigation is going to play out and be completed and what the result's going to be, but I think people are mildly optimistic, or hopefully optimistic, that a decision will come out, sometime third quarter or early fourth quarter, so that it'll at least be preliminarily an answer that may be helpful as that Christmas Eve deadline approaches.
Thanks very much, Chad. They didn't cast all their eggs into that one basket, though. Could you talk a little about the parallel legislative efforts which are being undertaken by the LSTA and others, Chad?
Of course. So there's also a bill in front of Congress right now to create what is basically called the Qualified CLO bill. It's based upon an LSTA comment letter. So they basically took their comments on the initial credit risk retention proposal and tried to create some improvements to the bill. It's passed out. That bill's passed out of committee so far, but it's as with many bills, I guess in Congress now, it is out there, but it has not been acted on. I'm going to run through in kind of a very high level the different pieces of the bill. What it tries to do is primarily create this qualified CLO, which have lesser requirements on it. It has. To meet such a test, the CLO has to have particular asset quality on the underlying loans, diversification in those assets. There's an attempt to create some rules in this that the CLOs have to internal provisions that the CLOs have to have that align the managers and the investors' interests. The manager has to be a registered investment advisor, which is an attempt to make sure that these people are regulated and they're reviewed and monitored by appropriate government agencies, and also requires specific reporting and transparency so that investors get information and know what's going on in the CLO.
Thanks. Astute listeners will realize that that's most of the CLO market today would meet the qualified CLO thing. So it would be a home run for the industry if they got that bill through Congress. I'm going to put you on the floor one more time, Chad. What are the next steps for CLOs given what you've just told us?
Well, I think there are a combination of the things we've talked about is one, continue to see where the litigation goes. Two, I suspect there'll be some heavy lobbying at Congress to try to push the statute through. And then, as I think we'll talk about in the next panel here, the backup plan is figure out how you're going to get this to work and how you can continue to do CLOs and structure it in a way that meets credit risk retention if it's still in place for CLOs.
Continuing to pick on CLOs a little more, basic math, Dave Augustin, is $400 million CLO, 5% is $20 million. That's a lot of money, even for large CLO managers. Be very interested to hear what you have to say about where that money is going to come from, who's going to provide it, how it's going to be done, recognizing, of course, that we're going to talk about that in more detail in our next panel. But
yeah, okay, excellent. So the way I think about it, and we've been talking about CLOs, and certainly that is, and the reason we keep gravitating towards CLOs right now is that's the asset class or type of security that is really hottest right now. What we're starting to find is we're starting to get questions on auto securitizations, and CMBS was thinking they were going to use, a lot of people were thinking they were going to use the B-piece option as a way to comply. And they're starting to think that there may be some problems with using that. So they're starting to think about capital raising activities as well. Some of the other asset classes are getting more engaged. So when I answer right now, I'm going to answer generally for all of the asset classes. Know, though, that much of what's been developed so far has been developed specifically through the CLO market. And what the others are starting to do is to look at that technology that the CLO market has developed and try and conform it into their situation. Because there may be nuances when you go to an auto securitization. So generally, the way I'd answer that question is you've got two ends of the spectrum. One end of the spectrum is I have capital laying around somewhere within the broader organization. Or the other end of the spectrum is I don't. Very simple. And of course, there's things in between, but largely you'll find people at one end of the spectrum or the other. So let me paint a picture. At the end of the one spectrum is, let's take an example, MassMutual. So MassMutual, large life insurance company, it has asset management subsidiaries that issue CLOs. Those asset management CLOs, when they're going to go comply with this, they have a couple options. They can raise capital, or they can just look across to the life insurance subsidiaries that are under the common control and the umbrella of MassMutual globally. And they could say, hey, here's a great investment. Would one of the insurance companies be interested in investing in this so that we can comply? And then once you figure out that as your plan, then you have to figure out how to get the capital in there. It may be that you have to take the capital and get it into the manager, and then the manager has to put it in. It could be, so you have a little bit of structuring you'd have to do. You might have to create a new entity, and then that entity is consolidated by the asset manager, but it issues an interest that goes up to the life insurance company. So there's a little bit of structuring you'd have to do. But the capital, the money, is coming from somewhere that's friendly, if you will. The other end of the spectrum is the small asset manager who doesn't have capital laying around. They really don't want, they're in the business of putting the deals together, managing them, making fees, not making investments. And while, as Chad pointed out, they don't think they really should be subject to this because they weren't the problem in the credit crisis. They weren't the ones causing all the problems. Therefore, they shouldn't be subject to it. They are, at this point in time, pulled under the umbrella here. So they have to come up with capital. What they're looking at is different vehicles and different ways that they can raise that capital. The first thing they start with is, that I always get as the first question is, what's the least amount of capital I have to put in and comply? So Paul just said some numbers, $400 million CLO, $20 million. And so you start with that as the starting point. as we first started looking at this, we started seeing structures develop where maybe I don't have to hold that. Maybe it's only 51 or 50.1% of that $20 million. And in the next panel, we're going to talk more in the details of this, but eventually we're getting to even lower levels than that. So you have to have a certain amount of capital in an entity, and that entity will then be used to raise capital from outside that's specifically focused on that $20 million. Other things that have come up as part of all of this is what's happening in Europe. They're ahead of us on this in that they've had capital requirements for these types of vehicles for a while. They have a whole solution base that they use in Europe. Some of the questions that I get are, I'd like to create a vehicle that can help me be compliant with European CLOs at the same time as they're helping me be compliant with US-based CLOs. And then the last aspect of it is other situations where, again, still under capital raising, but in a situation where I kind of do a spin-off of the operation that I have going on today, but it still looks essentially the same. And we'll get into more of the details of how those work. All of those and all of the structures you hear, MOAs, CMOAs, CMVs, all those things have at its core the same thing. How do I raise some capital when I'm on that end of the spectrum? Because I get a lot of people who tell me, I know that some of the deals have been noted as having already been risk retention compliant, but they didn't talk about an MOA or CMV. Why was that? Well, the likely thing is look to whether or not they've got a friendly nearby that they're able to gather the capital from that place. If so, they didn't have to do any of the MOAs or the CMVs and those other capital raising types of activities.
Thanks very much, Dave. Just to switch subject for a second and for some relief, Eric, would you mind talking about some of the legislative activities that the CMBS industry is engaged in?
Sure. There's been legislation that has come through and voted through committee to modify some of the proposals that were adopted in the final risk retention rule. One of them being that the B-piece buyer, which is an option for a sponsor not to hold any or some of the risk retention obligation, for that to be held in a senior subordinate structure. Currently, it has to be pari passu. Another change or a lobbying effort is for single borrower securitizations to not be subject to risk retention. The reasoning there being that the securities issued there are really investment grade, and the disclosure is much more robust. It's with respect to one loan only and one borrower, and contains a very detailed disclosure. And then the third portion of the law that's being proposed is to expand the definition of qualified commercial real estate loan, which is similar to the RMBS QM concept. Basically, today, the way the definition is written, no one that's participating, except for maybe one or two originators, can satisfy the definition with the current LTV requirements.
Thanks very much. I realize we're early in the program, and maybe you will have answers for your questions later, but any questions on legislative initiatives and the matters that we've talked about now? Yes, sir. Can we get a mic, perhaps, or? Actually, going forward, we'll collect questions on cards. They're all in front of you. If you could just make sure when you're asked to pass them along to the end, we'll collect them and read them out. So, apologies for the delay. Hold that thought, though.
Thank you. Thank you. Basil, quick question for Chadwick. So, for you had mentioned for the horizontal interest, do we always have to retain the bottom tranche, or could we retain any in the different classes?
It has to be the bottom tranche
Okay.
if you're going to do pure horizontal.
Okay. And can we have, let's say, a consolidated related party be the investor, or buy the securities, the certificate that is issued?
It needs to be there's restrictions on who it can be. It has to be the sponsor or one of its majority-owned affiliates. So if you were in the you have to fit that definition. But if you were an entity that's in your chain, in the corporate family, depending on your structure and stuff, it should be qualified.
Yeah, Basil, we'll get to it when you see the MOA structure. In the MOA structure, there's an important consolidation aspect to it that I'll cover in more detail. But the answer to your question is if the sponsor, whoever's deemed to be the sponsor, has to be the entity that consolidates the entity that holds the risk retention security. Okay. So to what Chad said, if you've got a parent in a simple capital structure or a simple org structure where you've got a parent, sub A and sub B, and then let's say, vehicle down below, if A is the sponsor of the vehicle, B cannot hold the risk retention securities and be compliant unless A consolidates B. So a lot of times what you'll have to do, and this is part of the structuring, you may have to drop a sub under A, have B put the money into sub of A, and then have A be the sponsor, A consolidate that entity, then you could be compliant. So it's a little bit of structuring that might be required because at the end of the day, the risk retention securities, the reg actually says the sponsor or its consolidated affiliate have to hold the risk retention securities. Does that make sense?
Yeah.
And one of the things you bring up a good point, in some of the structures when we look at it, I mean, most of the time when you set up the capital structure, there'll be enough of the variability of the fair value that's going to exist in the bottom tranche so that, as Chad said, you're going to probably hold a large portion or a lot of that residual tranche. Could it be that you have a much more thin residual, and then you have a subordinated debt that's in a level right above that? You could have to go into the second level. The requirement only says 5%. I just think practically you're going to end up getting at least 5% of the fair value. In most capital stacks are going to be in that one residual tranche. And that's why I think that's the way you answered.
Right, and that'll raise an issue that I think Eric will talk to in our next panel. But for CMBS, for example, you've got everything is tranched out, right? Or and RMBS for that matter. But for CMBS, everything's tranched out, right? So. And traditionally, your B pieces or your lowest pieces are all sold out. There isn't anything retained by the seller. And if you were to retain anything, your that 5% could go, will go, and this is part of the issue even with the B piece, will go beyond what is traditionally kind of considered the bottom of the stack.
Thank you. Just one more question, Dave. So auto loans, is it all auto loans that are in scope, or are there some maybe if it's used for personal use versus business?
Sorry, what was the last part of your question?
So I'm trying to figure out auto loans if they're in scope for the risk retention. So if you do a securitization of auto loans, is there only specific type of loans that are in scope, or is it all auto loans?
I'll have to ask the attorneys.
I think it's all loans, all auto loans.
Yeah, usually, Basil, when that comes up, it's the question of whether or not you're in risk retention or not. You'll see us accountants turning to the lawyers because at the end of the day, it's a law, it's a reg, and then our role is really just to try and help with the accounting issues. So I would suggest just to verify, you'll want to work with your attorneys on that.
Right. I mean, the general rule, right, is that if it's a securitization and that's a question, I guess, depending on what you're really doing. But if it's a securitization, it fits into the bucket, you've got risk retention. Doesn't matter if it's an auto loan, if it's auto leases, if it's, whatever new crazy asset class that people come up with next.
Thank you.
Okay, one more question and then we'll close.
Let's get the question on the. We're videotaping, so it'll be good to get the question on there.
This applies just to publicly registered ABS or MBS. It's not for private placement, 144A?
Applies to everything.
Even 144A would have to do
everybody.
this.
And
okay.
Recall that the risk retention rule was promulgated by 6 separate agencies, and ultimately the jurisdiction Will depend on what you are. If you're a bank, it's prudential bank regulators. If you're everybody else, it's SEC. If you're, unless the mortgage people, they've got HFA, FHFA, or whoever.
Speaking of acronyms, can we just make sure, I don't know what MOA, COV, LSTA.
Very good question, all to be answered in the next session.
Okay.
We're about to begin now.
That's a great segue.
Perfect. Did you set that up?
I didn't.
We're going to shuffle chairs, and then we'll start the second panel. Oh, sorry, we have one more question.
Good afternoon. Question is, if there's securitizations and then there are various warehouse kinds of fundings, are warehouse fundings considered to be securitizations under this rule, or if it is a loan structure, so it's not a securitization, is that different? If it's syndicated, is it different?
Chad, Eric, you want to field that, or are you going to
take that one first? That's an interesting question. And I don't know if there's necessarily a clear answer on that yet. I mean, I think if you're issuing notes and you're selling it to investors, you're clearly a securitization. If you're doing a structure, which some banks do, where they'll, single bank, loan effectively, but they're structuring it as a securitization, the kind of securitization technology, have the receivables go into an SPE and purchase and issue a note out of it and have the bank hold the note. You're starting to get into the gray zone. A traditional warehouse,
if there's tranching involved as well.
And that's exactly. That's one question. If it's a single level loan, then it's really looks more like a loan. If you're starting to issue multiple classes of notes in different capital structures, then it looks a lot more like a securitization.
In some ways, what is a bank that does a participation of a single loan? It's tranched up, well, not really tranched, but it's broken up into pieces just on a pari passu basis. I don't think I've heard of anybody go on the path of saying that would be subject to this yet.
Yeah, we usually get paid for those answers. Stuart, you have one more question, though.
No, actually, I was just going to supplement that answer. Stuart Litwin, hi. So, Jeb, the question is whether it's a 34 Act asset-backed security. So at the end of the day, in order to be a 34 Act asset-backed security, the starting point is a security. So if what you have is something that's, truly an ordinary commercial loan that everyone would conclude is not a security, then the risk retention rules wouldn't apply to it. And what you've done is you've sort of gone into a pretty good range of the hypotheticals that would kind of take it further. So if what you had was a syndicated transaction, it was, although it's all banks, it's all in the form of securities. You've got something that's called an indenture with an indenture trustee. And it walks and talks like a security in every respect. And what do you know, when you look at it, it was sold to lots of banks, and it was sold with something that looks a lot like an offering memo. That might be the place where you really kind of are so close to the line that you might say that in fact is a security rather than an ordinary commercial loan, and that the risk retention rules would in fact apply.
Okay, I'm going to close it off now. Clearly, if you have additional questions, you'll always have later opportunities during the day or at the networking event that follows. We're going to shuffle chairs. Chad, I think you and I are switching.
Well, Dave, I think we're going to start off with you because people had questions about all the different acronyms. In the last session, you talked about ways that organizations can choose to raise capital to, meet their risk retention. Can you give an overview of these activities and maybe describe some of the acronyms while you're doing it?
Sure, no problem. So, there we go. So when we get to the capital raising, there are a couple of definitions. Chad, if you go to the next slide, I think. There we go. So in this slide, it talks about some of those acronyms. A lot of this, again, are just different vehicles to use to raise the capital. The direct capitalization I talked about before, the second one, the MOA, so majority-owned affiliate. This goes back to what I said before, where the U.S. GAAP accounting made its way into the reg. And what it basically says is the sponsor has to sponsor or its consolidated affiliate. And it defines that consolidation under U.S. GAAP. So that's why the accountant is sitting up at the front of the table here. And when we first started this process and we thought about the MOA, the idea was that you would have to consolidate that. There's two models that exist in U.S. GAAP for consolidation. One is a normal voting entity, and we call those voting entities. So if you have a regular operating subsidiary, the way you determine whether or not you consolidate is if you have majority ownership, so greater than 50% of the voting common shares. You've got other entities that were in this literature was created after Enron called VIEs, or variable interest entities. These VIEs are limited in what they do. And when you look at a VIE, it's different criteria for determining consolidation. So when people started naming these, they said, oh, well, has to be a consolidated entity. So the first people that named this said it's a majority-owned affiliate. That's merely the way that came about. So in the beginning, people were saying, going back to Paul's numbers, 400 million, I need 20 million of securities to be risk retention compliant. Therefore, if I can set up an entity, I can consolidate that entity and put in 50.1% of the capital, and then I can raise the other 49.9. I can comply. Now, what happened over time was once the accountants then got to the table, we said, well, wait a second, what kind of an entity is that MOA? At the end of the day, it's a VIE. And once it becomes a VIE, the rules that exist for VIEs are focused on who has first the power over the most, who has the power over the most important activities of the entity that determine its economic success. And then secondly, you have to have more than an insignificant amount in the entity. And more than insignificant is in the process of being changed today. It used to be much lower. That level has come up to about 10% now, so that to comply under the new rules, the new consolidation rules, again, you'd have to have power over the entity, which is easy to manage in this situation because that entity is not going to do anything other than hold these risk retention securities. So giving the power to the sponsor is pretty easy. And then secondly, we've now got ourselves down to a level that's not 50.1, but 10.1. Now, when I'm talking to clients about this MOA structure, I usually will then like to talk about newspaper risk. Because at the end of the day, remember what the basis was here. The basis for this was to make sure that the sponsor has skin in the game. And in the beginning, we all talked about, and the regulation was anticipated when whoever wrote that wasn't an accountant, because they wrote it saying 5%. And then they put in that consolidated entity. They didn't really understand VIEs. So I don't think they really understood that what people can do today to comply is only 10% to 5%. Much smaller level. And I think, who knows? What will happen? Will there be a Wall Street Journal article someday that says, hey, by the way, this regulation came out and it was supposed to have 5%, and everybody kind of structured around it, and now we're down to 10% of 5%? I think that's always going to be a risk that's out there if you go down that path. We just don't know how it's all going to play out. The CMV is different. The CMV, it takes a different tack to this. And what the CMV stands for capitalized manager vehicle. In this situation, this vehicle is still going to raise the capital, the $20 million in Paul's example, that is going to be used to purchase the risk retention securities. The difference here is that we're going to want to make sure the CMV is not consolidated. And secondly, that we make sure that the CMV is the principal asset manager for the CLO. So if you draw your picture, and let's go, so this one is the MOA. Go to the next slide, and then we're going to come back to that one. So you can see here in the CMV, you've got the CMV sponsor right there in the middle, the CLO at the bottom. The CMV sponsor will have, in this situation, the third-party sorry, the CMV is going to be both the asset manager and they're holding the risk retention interest, and the third party puts in the economic interest to buy the risk retention securities. That third party investor money comes in through the CMV up top to the right. The third party investors to the side are the ones that are just buying the CLO securities. And then the CLO manager, the current entity today that's the manager in this structure, is going to have a sub-advisory arrangement with the CMV. So I sometimes refer to this as the spin-off option. In essence, what you're doing is you're spinning off your asset management operations into this entity called the CMV, forcing them to become the sponsor and hold the risk retention securities, and then having the capital come into the CMV from the outside at whatever level you want. At that point in time, again, what you got to make sure is that the CLO manager does not consolidate the CMV. So there's a couple of entities that have done this. There's one public entity. You can look in their 10Qs and 10Ks if you'd like. It's a bank down in Texas called Triumph. And that organization went through the process and has done the CMV structure for theirs. There's certain upsides and downsides to both of these. In the CMV situation, at that point in time, all your people still sit in the CLO manager entity. They're just now a sub-advisor. And you're going to earn fees. You're going to have fees in your financials. You can also, by the way, as the CLO manager, hold an interest in the CMV as long as you don't consolidate the CMV. So I think we'll find that many of the CLO managers will both have the sub-advisory arrangement, but they'll also get economics back through the original CLOs through holding an interest in the CMV itself. Maybe go back to the MOA slide, just the next one. So in this one, just to compare and contrast, the key aspect here is that the CLO manager needs to consolidate the MOA. The MOA is now going to hold the risk retention interest in the CLO, and different than the CMV, the asset management agreement is directly between the CLO manager and the CLO. So this has the basic setup that exists today. The only two boxes you're adding to this is the MOA and the third-party investor that goes into the MOA. Everything else is the standard transaction that exists today. Sure, we can. That's okay. Hold on just a second. We can take some questions as we go along if there's something that's pertinent to that particular point. So hang on for the mic. Correct. So the question, because I don't think that might have come through, is these two structures, the MOA and the CMV, look very similar. And it's very important that one consolidates and one does not. Maybe, Chad, to help, can you go to the MOA for a second? Remember what I said, that the regulation says that the party who is deemed to be the sponsor has to be the one, it or one of its consolidated subsidiaries have to hold the risk retention securities, right? So if you go with that, then in that scenario, if the MOA is holding the risk retention securities, then it has to be consolidated by the CLO manager, because the CLO manager stays as the sponsor in this setup. Okay? Now, if you move to the next slide and you look at the CMV, in the CMV, we're flipping the sponsor from technically being the CLO manager, because now it's just a sub-advisor. Now the sponsor becomes the CMV. So if the sponsor becomes the CMV, then in that situation, you want to make sure as a CLO manager, because you're trying to keep all of this off your balance sheet, you might look at this as a way to make sure that you don't consolidate the CMV, because now the CMV is the sponsor and it's the one holding the risk retention securities. Okay?
Dave, maybe another way to think about it, right, is that as you talked about on the two goalposts of potential, capital sources, is in the CMV version, or actually no, in the MOA version, you don't actually need a third-party investor at the top, right? That could be if the CLO manager had their own money, or that's an affiliate, or it could be an affiliate that has its own money that could take over that role there. So that's sort of maybe that's one distinction that doesn't jump out here.
Exactly. No, that's a good point. So in this picture, see where it says third-party investor at the top? In my Mass Mutual example, that could be Mass Mutual. So Mass Mutual Life Insurance Company could be the one that puts in the money into the sponsor, or a large portion of it. As long as the CLO manager consolidates the MOA, you can comply. The other thing Mass Mutual could do, if it wanted to, depending on tax and other regulatory, is Mass Mutual could always just pump the money in through the CLO manager directly, which goes back to the scenario where the other end of that spectrum, where you don't need to do a capital raise, the money gets pushed into the CLO manager. The CLO manager is both the sponsor and then holds the risk retention securities. So I know this is all very confusing, but trying to break it down to just some of the bare bones in a very easy example. And like everything, this is on the surface of it. We can go deeper into a lot of other complexities. Okay, I think that kind of covers the alphabet soup.
Thanks, Dave. Eric, do you want to give a brief overview of the alternatives for the CMBS structure?
Yeah, absolutely. As far as risk retention in CMBS, we start off with the baseline that, a 5% portion of the deal needs to be retained. That can be by the sponsor, vertically or horizontally, or in the case of CMBS, by what's called a B-piece buyer. The B-piece buyer is traditionally the entity that buys the absolute bottom of the capital stack, including the non-investment grade securities. The B-piece buyer is also usually the special servicer in the deal, so the B-piece buyer will realize its yield, from the actual payments on the securities, and also special servicing fees to the extent that there's trouble with the collateral. The servicing of that collateral goes from the master servicer, which will be, your big bank, your Wells, or your Key Bank, and then it'll be transferred over to the extent that payments are missed or there's a maturity default or something else to a special servicer, and there'll be fees there for the actual servicing and for liquidation, et cetera. So that's kind of where the B-piece guys play and how they make their money in the current environment, and how they have traditionally for a long time. With the B-piece option in risk retention, the B buyer can take the obligation off the sponsor with respect to the holding of the risk retention. This is good for the sponsor. Most times the sponsors are large commercial banks, which if they take down a vertical security or a horizontal exposure, that'll be a securitization exposure for them. It'll trigger, risk-based capital rules where sometimes they'll have to hold dollar for dollar with respect to that security, depending on what the rating of it is. So having the B-piece guy in there takes a lot of stress off of the sponsor from having to satisfy the risk retention obligation. It also cuts the other way because it gives the B-piece guy a lot more leverage in negotiating pricing and kickouts with respect to loans.
Thanks, Eric. Flipping back to CLOs, Paul, Dave gave a good description of sort of some of the high-level structures. From a legal standpoint, what are you, or the industry generally, what issues are you guys struggling with or thinking about in these different structures?
Thanks. Well, actually, Dave did give a very good overview. In fact, I'm going to propose him for an honorary degree. If you could flip to the MOA chart, let me try and talk about that first. A couple of things come out from this. Firstly, this structure uses a new MOA, but the management stays with the CLO manager, so you don't have anybody not doing what they would normally do. In contrast, and I'll talk about this in a second, the CMV structure creates a new manager, so you have immediate questions about regulatory requirements, and specifically, does that entity, as a result of this new management activity, have to become a registered investment advisor? Or, and for those who are interested, we could get into this, is it able to qualify as a relying advisor on the existing registered investment advisor's registration? The second area we spend a lot of time advising clients about is CLOs exist because of their tax efficiency. Obviously, we're able to structure transactions which qualify for portfolio interest, and we're able to ship a lot of U.S. income offshore in a very attractive fashion without tax incidents. The minute you introduce a management service type activity, you potentially taint that income. And so if you could flip to the CMV structure now, a couple of things are observable here. One, as I mentioned, the management agreement between the CLO and the CMV creates the regulatory question. The economics which you're trying to attract and segregate and make available to the third-party investor now runs a serious risk of that income being subject to U.S. tax, because the activity of the CMV is going to potentially be engaged in U.S. trade or business and subject to U.S. tax. Again, without getting into proprietary details, there are a couple of options as to the way you might structure the CMV. But again, our experience would really suggest the CMVs are, I think, dramatically more complicated than the MOA. They're really, I think, best thought of as joint venture arrangements. Like all joint venture arrangements, you have to think about the life of the deal, what's going to happen over the life of the deal, who's going to be doing what happens if parties fall out. Dave alluded to the fact that because of the sub-advisory agreement, a lot of people aren't requiring CMVs to actually have employees. That works until there's a problem, and you need to perhaps sever the relationship with the CLO manager, terminate the CLO manager's sub-advisory agreement, and really run it like a standalone business. Who's going to perform the management services? Immediately you can see you start to raise a raft of issues which you really have to think about and work through. Adding to the complexity, I'd point out we've had a couple of people combine the CMV and the MOA structures into what we cleverly call the CMOA structure, and the goal there was to try and take advantage of the favorable attributes of both. But there's endless complexity and endless creativity, which the marketplace is exploring as we try and raise massive amounts of capital for the CLO business. And as Dave and others have described, all this technology is available and works, we think, for the most part, for other people trying to satisfy the same risk retention question.
Thanks, Paul. So assuming none of the legislative or litigation solutions that are out there that were touched upon earlier bear fruit, where do you guys, actually Dave and Paul, where do you guys think the market's sort of headed, assuming that the risk retention rules stay as is, for CLOs particularly?
Well, I think we've seen impact already. Clearly, there was a lot of market volatility and dislocation in the first quarter of this year. Issuance was way down. I think you can't wholly explain the lack of activity by market conditions. I think risk retention was in the forefront of discussions that managers were having with investors. Certainly, if you were a mid to low tier manager, the first question that the investor asked was, well, what's your risk retention plan? What are you going to do? Rating agencies were asking about risk retention plans and strategies, so they were clearly a combination of forces on managers to come up with responses to those questions and to have a real manageable plan. The issue for smaller managers has been, while in theory these arrangements work, there really haven't been capital options available to them. There are a few people in the market. I'd be happy to provide you their names and phone numbers if you want, but there really hasn't been a massive influx of capital on to be able to provide the financing for MOA or CMOA arrangements. I think that's an untapped opportunity. I think if the market were to restore to more normal activity levels, we'd really be strained for capital. Again, $20 million for a $400 million CLO for I don't know how many deals we did last year, but it's a lot, and it's a big number. And clearly, the cycle in the CLO market is really starting to run pretty adversely, to the extent that we've got a lot of legacy pre-crisis deals, which are out of reinvestment, out of call, or no call rather. We've certainly got early crisis deals about the same place because they had shorter reinvestment periods. I saw some numbers, 70 billion plus or minus was called last year. Projections are for similar numbers this year. And on a $400 billion market plus or minus, that's a lot of paper that in theory needs to be replaced and repriced and, put back into the market, all of which, certainly now probably has to come close to satisfying these requirements. So there's a lot of money that has to be raised in a reasonably short period to keep the CLO machine working.
Yeah, I'd have two observations. The first that I hear, and these are both sort of in the complaint category. The first is the costs. There will be, and there are going to be. In fact, there was just recently an article that talked about all the costs, the extra cost that this is going to force on. I think everybody understands that, right? That's what happens with more regulation is more costs. So I keep getting a lot of questions and comments about how this can't be that good. Is it really that much of an investor benefit? And we're spending so much money just to be able to comply. Obviously, over time, once some of the structures are in place and everything's been thought through, hopefully those costs will come down, but there's still going to be a base level of costs that are going to be added to the industry. And then second, another interesting aspect of what's happened is the competitive advantage that those have if they have access to capital. The ones that are most able to be compliant as quickly as possible are those that have access to capital. And if you have that friendly that has the capital, you're in a better spot. So the folks that have complained to me are obviously those that don't have that capital nearby. They don't have a friendly close by that has it, and they got to go out and find it. It just adds a lot. It's an aspect of their business operations that they don't want to get into. If they didn't have to. So those are a couple of the ramifications that I guess I've seen.
Great, thanks. Eric, switching back to CMBS here. Let's see if we jump ahead a few slides. You talked a little bit about the high level of the B-piece buyer. Can you give us a little more detail on how those work and maybe some of the specific challenges that people have, and then how that ties into the proposed legislation and how that may solve some of those problems?
Sure, absolutely. And I guess it's worth noting that, the B-piece option was really something that when the comment period with respect to the final regulations and the first proposed regulations were, being considered and comments letters were being written, the B-piece option was the option that people thought would be used. In the market today, there's a lot of uncertainty as to whether the B-piece option will be solely used to satisfy risk retention on deals for some of the reasons I'll go into. But to the extent that you were able to find a B-piece buyer that was able to tolerate the hold period for the securities and go ahead and take the obligation off of the sponsor. The guidelines are pretty clear as to what that B-piece buyer needs to do. There can be one or two of them, but they cannot hold currently in the senior subordinate structure. It needs to be pari passu. The loans that are in the pool need to be commercial real estate or servicing rights. And the source of funds, the B buyer needs to pay in cash at the closing. There's restrictions on hedging and financing later, but you need to close with cash. And similar to the way the market works now, each B-piece buyer comes in. Sometimes they do it in-house, or they'll hire another diligence firm, and they basically come in and re-underwrite each loan. At this point, they're able to kick certain loans out of the pool, whether it's for a credit reason or other reasons. Maybe they had a bad experience with one of the sponsors or the guarantors in a prior deal. There could be a multitude of reasons why a B guy could kick a loan out of a pool. And when loans are kicked, this raises the cost for the sponsors. Maybe banks that have a lot of capital, the cost isn't as much, but you have a lot of, in multi-seller deals, other smaller finance companies that rely rely on warehousing. That warehousing has, a finite capacity. If they have a lot of loans that are kicked out of deals, this could really impact their pipeline and also their costs because they have higher warehousing costs. As far as affiliation, they could be affiliated, the B buyer, with other investors. They normally are the special servicer, and they may be affiliated with a certain number of the originators. Consistent with all CMBS 2.0 deals, there needs to be an operating advisor within the deal. The operating advisor is an entity that watches over the special servicer. They get all the reports to the extent that certain classes are wiped out and the B class goes down to 25% of what it was. The special servicer needs to consult with the operating advisor to the extent that there's material decisions being made, and if the special servicer is not operating in accordance with the servicing standard, the operating advisor, with the consent of a certain number of note holders, is able to remove them. As far as hedging, transfer, and pledging, this is where the rubber really meets the road for a B-piece buyer. Normally, in all deals other than RMBS, you can transfer your retention interest when the deal gets down to 33% of the original pool balance, or 2 years after the closing of the deal. That's not the case for, or practically, that's not really helpful for CMBS because it's the later of those two dates. And the way that CMBS loans are, it's usually either an IO loan or a loan that's maybe 10 years and calculated, with interest paid and principal paid on a 30-year amortization. So it's going to take a very long time for that deal to get down to only 33% of what it was on day one. So that leaves a B-piece guy having to hold, if you have $1 billion deal in CMBS, which is not uncommon, that's $50 million that the B holder would have to hold on to, and they would have to hold on. There's a special exception for BPs where they have to hold it for 5 years. So that's a tremendous amount of illiquidity and uncertainty on an investment. Holding $50 million for 5 years and not being able to go ahead and sell off a portion of it, which is what current BPs buyers do before the regulations. They usually buy the bottom of the deal and sell off the top portion of that bottom of the deal in order to realize some profit. And what they're really interested in a lot of times is keeping the special servicing rights, which is what the bottom holder has.
Thanks, Eric. One of the other options under the CMBS is the qualified commercial loan. I think there hasn't been a lot of expectation that would be a fruitful option. Do you want to maybe explore some of the issues on that and how the new rule might help that? Yeah, the issue with the qualified commercial loans is no originators are really originating loans that meet that definition. The LTV standard is just not what's in the market now. Other people are coming up with ways to satisfy risk retention. Some of them are ways that weren't really thought about as much as the B piece option. A lot of people today are thinking about even holding the vertical strip, whether it's a single vertical security or buying 5% of each class that's issued. It's worth noting that if a sponsor holds a vertical portion, part of the risk retention obligation can be satisfied by that vertical portion, and a portion can be satisfied by the B piece. So you can have a little bit of a mix there and have an L shape. To the extent that you have a multiple seller deal and several originators that are originating a lot of the deal, if the originator is originating 20% or more, that originator can take down some of the risk retention obligation, once again to eliminate some of the stress on the sponsor, which is usually a commercial bank that, in order to hold that security, has a high capital charge. Several players in the market, including finance companies and B-piece buyers, have also
kind of floated around the idea, it's come and gone, ebbed and flowed over the past couple of months, of setting up their own shelves and then being the issuers and then taking a vertical slice or a single vertical security in the deal. The benefit being there is if they do that, then there's 95% of the deal that can be sold. The bottom portion doesn't need to be held for any amount of time because the risk retention is satisfied otherwise, and they're not subject to the risk-based capital requirements because they're not a bank.
Thanks. Paul, do you have any thoughts on any of the other asset classes that might have some specific issues or challenges going forward?
I do, and I'd like to explore a little more detail on some of the financing issues. Again, my context and experience with CLO, but it will apply, I think, more broadly to other asset classes as well. Could I ask you to put up the MOA slide?
Which one do you want?
The MOA? I think it's like the second or third. Too far. Okay, and recall, as Dave explained, this is really a way to minimize the actual cash investment that the CLO manager needs to put in to satisfy risk retention. Third-party investor money is most sensibly put in as leverage on the risk retention instrument. There are a couple of issues which have fallen out of our attempts to actually put in place financing arrangements like that. The first is the requirement in the rule is that recourse has to be, quote, full recourse. And so the immediate question you face is who's the borrower of that financing, and are they in fact a real enough entity so that it's not a device to escape the requirement for full recourse. And the market is struggling with the amount of equity that is really to be required to support a claim that the financing meets the requirements of the rule, and you've in fact got sufficient recourse for that. There are other issues which follow from that. You know, where is the collateral? How's it held? And in particular, where, as we've seen in some cases, to make the economics work for the lender, you give them a piece of the management fee. How do you carve that off, and how do you give it to them, and what are the consequences to them of getting a management fee? Does that make them an investment advisor of some kind? So there are a lot of issues that you will find as you start to explore financing options to get the leverage that you want. I'd also note that leverage considerations are different based on what the risk retention investment is. If it's a vertical strip, you've obviously got a lot of high quality exposure, which in theory would support higher levels of leverage. That ultimately is going to put more pressure on the full recourse question. And certainly if you've got equity, you've got, in theory, a lot more juice to support and pay for financing. But again, you've got significant equity risk and exposure. One of the really technical questions, which has bedeviled lawyers and others who've had to deal with these questions is, and I think Dave alluded to this question about, you know, what does it mean when you don't comply? You're successful, you put your financing in place, something bad happens, and all of a sudden the financing's now in default and the lender wants to foreclose. If they foreclose, they're going to take the risk retention investment, and how does that leave the manager, who in theory is still required to have a risk retention investment because none of the other exceptions to the requirements apply, and all of a sudden his lender's taken the collateral. That's one of the worst unanswered questions and aspects of the rule. Nobody knows the answer to that question today. Hopefully we get more guidance from somebody soon. But until that happens, one of the really awkward discussions that we're having with people is just that, okay, yeah, bad things happen. I'm in default. I owe you the money, but you can't take the collateral because I'm going to jail. And that would be very bad. And figuring that out and writing, foreclosure events and limitations on foreclosure is a massive undertaking. And if I could just circle back to Dave's question, as hopefully our comments have illustrated, these are not insignificant arrangements to put in place. Even taking a pretty straightforward financing can become a significant exercise. Most of our clients are looking at this as multiple transaction solutions. It's just too much for one transaction to bear a burden for the cost of these types of arrangements. And certainly I think longer term, as we really figure out some of these questions and we get better at writing them, I think fund-like solutions where you raise lots of money, and I think Apollo has got a fund like this, lots of money from investors, and then you come in, apply that to these arrangements in these ways, will make this all work. But we're a long way from that right now.
Yeah, I think that's a good point. If you look at this structure, this picture, if you're a manager and you do 4 to 6 of these a year, CLOs, you could use one MOA. So you'd have one MOA that would be the party that would hold the risk retention securities for all 6 of the deals you do in a particular year. And you could roll that, and then the next year you could have MOA number 2 and 3 and so on. Or you can create a new MOA each time, but obviously the costs go up the more MOAs that you create.
Paul and Dave, maybe you could expound, because maybe not be obvious to everyone, what the risks are of just having one MOA for all your deals versus creating new ones?
Well, there are a couple of things that occurred. I mean, one is, again, you've got full recourse. If you do a single deal, with one borrower, one underlying risk retention investment, you put a lot of pressure on the full recourse. If you do more deals, you actually take some of the risk away because you've now got an entity that's, making multiple investments across multiple deals. It just looks like a, better arrangement. And you've actually got the benefit of cross-collateralization of the risk retention investment. So all in all, it's actually preferable from a credit perspective to pool and bundle these deals for financing reasons.
Yeah, the only thing I can think of is, again, you'd have more costs if you just did one every deal.
I guess if you did one MOA, though, you do increase your risk of, I guess, if you have an issue with foreclosing on the collateral now, instead of one deal being in default, you've got every single deal in default potentially.
If you cross default them, yes.
Thanks. Eric, with respect to the CMBS front, do you want to give some thoughts on some of the issues and challenges and structures that people have been thinking about with respect to financing or otherwise dealing with their horizontal piece, if that's the route they go?
Maybe, Eric, before you answer, I think there was a question here on
actually, it's on the CMBS side. And there's a whole series of these questions and they're but I'd love you to start exploring them. Let's say your sponsor, you choose the B piece option, you sell it to the B buyer. 3 years later, B buyer gets financing, does a senior substructure, whatever. What happens?
Well, that's the rub there. The sponsor is the one that the risk retention obligation resides. So, there could be liability, whether that's, a fine, whether that's, not being able to issue on the shelf or under, certain exemptions. The obligation is always with the sponsor. It's not with the B guy. So you would assume that if you're going to use the B piece option and they're going to satisfy all or a portion of the risk retention obligation, you're going to have, a strong indemnification from them. You're going to have reps, you're going to have warrants, and you're going to monitor it. It gets a little tricky too. What happens if that entity goes into bankruptcy? The trustee comes in and sells the piece. A lot of this is out of your control. So it's a little bit concerning for the sponsors, especially, big commercial bank, conduit fusion public style CMBS deals, to go ahead and put this on the B guy. It was, a great idea, and everybody thought that would be the way it would go, but a lot of people are rethinking it now.
If you can hear me now, I noticed in your presentation you talked a little bit about the affiliation of the B piece buyer with any of the originators or the sponsor. Can you talk a little bit about that? Because if there's a control issue, what if a sponsor could have some control over the B piece guy, but maybe he can't because of the other rules?
Yeah, the B guy should be unrelated to the sponsor of the deal, the issuer, the depositor. That's a separate entity. They are normally affiliated with or are the actual special servicer because that's the business that they're in. They won't be affiliated with the trustee or the master or the operating advisor or anybody in there.
The structure where you have multiple sellers and you have some of the sellers take back a portion of the pari passu vertical. You've got, the sponsor is the shelf, and that's the main guy, the Wells or the Deutsche or whatever. The other guys take back 20 each or 30 each and whatever. Maybe one of them regulated or not, one of them does something wrong. Maybe it's a smaller entity. It goes bankrupt. They are forced to sell somehow. What happens there?
Yeah, that's a great question. And it's good to also note here that the regulations specifically say that in multi-seller deals, those sellers can't go ahead and decide to divvy up the obligation, et cetera. It has to be an originator that originates over 20% of the pool to take it down. So they could take a portion of that risk retention. The risk retention obligation, is generally with the sponsor and the issuer of the deal. So if something happens and one of the other guys, goes and hedges or, finances on a non-recourse basis, then they're going to be the one, it's their shelf, and they're going to be the one that is subject to liability and possible sanctions, whether those are fines or limits to doing further deals. And issuers are taking, a real close look at who their partners are now. You're not seeing, people really interested in having 6, 7, 8 loan sellers anymore, and that's been a general, for this reason and for others, a general, kind of contraction of these deals that are, really, really multi-seller. People are choosing their partners, very wisely in thinking about this.
Thanks for the question.
Yeah, I have two questions. One is in one of the BP's option alternatives, you mentioned MOA. Can you elaborate how that would work from a CMBS issuer perspective?
Yeah, the MOA is definitely not as attractive in this particular structure for the reason that, if you look at the law overall, the B piece, it as currently the way it stands, putting aside the pending litigation or legislation, the interests have to be held pari passu. Anybody that would want to do an MOA would most likely want to, tranche it out within that vehicle, and a lot of people are very hesitant to think that would work, and not many people want to be the first guy out of the gate on that. That's something that people have discussed, but it's gotten a lot less attention in the CMBS space than some of the other alternatives, especially over the past 2-3 months.
My second question is back on the actual question that a gentleman just asked about the affiliation of the B buyer with originator. You said as long as the originator has less than 10% contribution, that's
correct.
Okay.
Great, thank you.
You mentioned that the structures and everything also apply to other asset classes, like let's say an auto loan. Does the B piece option apply to an auto deal? Does this MOA, do any of this apply? And who would be those boxes that you would fill in for an auto?
Well, the B piece option is only for CMBS. That's clear. That's just a CMBS option, and it's born out of the fact that they've had these B piece buyers in deals, traditionally for as long as CMBS has been done. And the reason why it's allowed is because these are companies that actually come in, diligence, and re-underwrite the loans.
So what we're seeing in the auto loan space is when you think of an auto loan situation, what typically happens in the marketplace today is that there's it's more of a normal securitization vehicle where the originator sells through a bankruptcy remote entity into a trust and then retains the residual portion, sometimes called over collateralization. Sometimes that's provided in a reserve account. Sometimes it's certificated in some kind of an IO strip. It could be in many different ways, but generally most auto loan securitizations are set up where that residual is already held by the originator transferor. In that situation, to comply with risk retention, all you're going to have to do is verify that the amount that you retain at least gets you to that 5% level that's required. And
but what if it doesn't get you to that?
So if it doesn't, then you either have to buy more, you have to go up the capital stack and buy more, or you have to, and if you don't want to put up the capital to buy more, then you have to go out and raise the capital. If you have to go out and raise the capital, then you're likely looking to an MOA or a CMV type of a technology. Again, not very well developed yet. We haven't really spent time talking with the attorneys and bankers and everybody else to figure out how to execute that outside of CLOs. But I think they'll use the same technology to try and raise that capital. But it's really, again, I emphasize back to a capital raising perspective. Otherwise, in most of the deals, it's probably that the residual is going to allow you to comply with that. And so just by doing the normal course of what you do today, you might be okay.
Yeah, just to be clear, I think it's the MOA option that works for other asset classes the easiest. And again, it's just the best way to think of how I'm going to leverage the risk retention investments I'm required to make and still satisfy the rule. And again, I think the technology is applicable to really any asset class.
Go ahead.
Just a question. You mentioned that the residual has to be defined as 5% under GAAP. And I guess the question I have is, under GAAP, what are the measures that are required to be defined in order to calculate what that value is? Is it loss rate? Is that, because the loss rate that an individual issuer thinks is appropriate may not be what the rating agencies think. Discount rates may be different. How does all this get boiled into the GAAP definition of value?
Yeah, another well-placed question. So our third panel is going to go into that in very short order. It's a fair value calculation, and the third panel is going to go into a lot more detail on that. So if you don't mind, hold your further questions till that panel.
If I could just add one gloss, I think it's entirely different as a result. The rule says 5% fair value under GAAP. Doesn't matter what the rating agencies think fair value is. Doesn't matter what the 40 Act says fair value is. In theory, it's a totally independent test and concept. So sorry.
And a good point on that is, I don't want to steal thunder, so we'll let them come up. There is one point that I didn't make yet that I was thinking of, Chad, if you don't mind, for a moment. So one other thing, just from an accounting perspective, that will come up is the other consolidation and reporting issues that will come up. And looking at this picture for just a second, one of the things we're starting to find is that MOA, the investors are demanding it be audited. So at that point, a couple of ramifications. Number one, more costs, because the auditors are going to need to get paid. Number two, you have to do accounting at that MOA level. And sometimes, and we're starting to get a lot of these questions. I always tell my staff, it's always funny because things come in 2s and 3s in terms of technical accounting questions to me. I never get a single question that somebody else doesn't come in a near term. So I'm starting to get questions on what is the accounting by the holder of a CLO security that's a residual, because it doesn't have a coupon. It's usually a residual, but it's in the legal form of debt. And so what is the accounting by that party? And we're starting to get that because that MOA now has to do its own standalone financial statements. And in that circumstance, the CLO manager is also consolidating that MOA. So there's accounting questions you're going to have to answer about, are you going to do fair value option, where you're going to market to market every period? Are you going to do something other than fair value, which would likely be some kind of a cost accounting? You might be able to get to an AFS security where you market to market and the mark goes through OCI. So you're going to want to think about some of those questions. And then the last thing from an accounting perspective is, when you look at this structure, think about the path that CLOs have gone from a consolidation perspective before we even get to any of this. So let's take Ameriprise. So Ameriprise got into the CLO market and they manage and create CLOs. Under FAS 160 or FIN 46R, so after Enron, many of those CLOs, they did not consolidate. After the credit crisis, we got FAS 167 and they changed the consolidation rules. Many of those CLOs ended up getting consolidated by the manager. So these are for the public companies. If you're a private manager, sometimes they don't even have audits. They don't care if they consolidate the CLO or not. But in any public entity that has to do consolidation, that consolidates the manager is going to want to understand whether it consolidates the CLO. So after 167, so starting in approximately early 2010, the manager started consolidating the CLOs. The newest piece of consolidation literature was going to have all those CLOs go back off balance sheet for entities like Ameriprise. So they had this boomerang with all those CLOs. Now you're going to add the risk retention piece to it. And if the CLO manager is Ameriprise's subsidiary and it consolidates the MOA, and now the MOA has to hold this 5%, the question is going to be, is Ameriprise, through the manager, going to have to consolidate, or through the manager and through the MOA, going to have to consolidate the CLO? And if the answer is yes, then guess what? It's boomerang back again onto the balance sheet. And I won't get into, I would need another couple of hours to go through the application of the consolidation literature there. Suffice it to say, if you're going to buy a vertical slice, you're not probably going to consolidate the CLO. But if you're going to buy a horizontal slice, you are. So CLO manager that's private, that doesn't even get audited financials, won't care about that. But if that CLO manager is part of a consolidated set of U.S. GAAP financials, that entity is going to be very concerned or want to understand whether it's going to consolidate the CLO. Can't answer that question until you know how they're complying with risk retention and whether they're buying vertical or horizontal. So just another accounting question to put on the list that you're going to have to deal with at some point.
Thanks, Dave. I think we're nearing the end of our time. If anyone has any final questions out there. Doesn't look like it. Paul, Dave, Eric, if any of you have any final parting thoughts here in the last few minutes?
Yeah, I'd like to talk a little bit just to kind of wrap it up and look big picture, talk about kind of the economic costs and the costs of compliance with the rule in the CMBS sector. We're seeing a lot of parties get more negotiating power than they would normally have. The B buyer, to the extent that they're able to satisfy the risk retention, is able to demand more kickouts, more pricing concessions. To the extent that you have a deal where a entity that's normally a finance company or a B buyer sets up their own shelf, they'll remove a lot of the control and a lot of the economics from the entity that normally has it, which is normally a big commercial bank issuer. In order to have a shelf, you have a lot of setup costs to actually get the shelf active. You have other costs and other compliance that you need to put into effect, including the new Reg AB2 requirement where the depositor CEO needs to take personal liability with respect to the securitization and his certification that they deliver. That'll be another set of compliance that you need to set up. Maybe some of those costs are passed on to the other sellers. So it's just a very, very, very difficult balancing of power and economics in determining who is going to actually hold this risk retention in CMBS.
Thanks, Eric. Dave?
My comments were what I had before, so thanks.
You're good. Paul? We have one last question.
In a public securitization where you have a depositor CEO and you are availing yourself of the MOA or any other structured risk retention vehicles, does that depositor CEO take any incremental risk over and above holding a normally structured residual interest?
I think it's exactly the same because the depositor CEO is certifying that they've taken reasonable steps and they've reviewed all the documents, and if the deal works as structured, they have a reasonable expectation of the payoffs to work the way that they're described. So I don't think there's any additional incremental liability.
Yeah, I think I'd echo that. It's not on that certification, at least. I mean, you've got the issues we think they talked about earlier that, if you're not using your own subsidiary, if you're using some third party to do a B piece or something else, is what happens if they fall down on the job.
Or aggressive financing, you better look good in orange.
Another option, yes.
Yeah, that'll be on the sponsor, though, not on the individual depositor CEO.
You guys have two examples here, the MOA and the CMB. Have either of these successfully gone through a publicly rated transaction execution yet? What I'm thinking of is specifically whether the rating agencies have inputs on reps and warrant issues and transition of reps and warrants, or are these just theoretical in nature?
No. We've done both MOA and CMV and had rated securities. And actually, just so you know, I heard yesterday Moody's is no longer rating combinations, so the vertical strip thing is in question until they tell us how they're changing their methodology. But the rating agencies have reviewed these structures, understand the structures, so and haven't, as far as I can recall, imposed any additional requirements.
And I think an important point there is that this doesn't really change. I mean, obviously they're weighing in and they care about it, but it doesn't really, this is just not outside the deal, but it's who's holding the pieces of the deal. It doesn't really affect the underlying cash flows in the deal per se. So,
yeah, the only way it really has come up is many lenders have wanted separate ratings on the combination strip that they're taking as collateral, just for insurance. The insurance companies in particular do it for NAIC pass-through treatment, but. That's really it's really recycling capital is how I think of it, and it doesn't affect the underlying deal at all, or shouldn't.
Great. Well, thank you, panel. No other further questions. We'll break for refreshments.
Welcome back. I think topic of discussion has already been teed up initially with an overview and question. So really the topic is disclosure and determination of fair value. And Julie, at the beginning, your colleague Chad had sort of teed up sort of the options for risk retention, one of which is referred as to the horizontal. So if you could sort of take us through with regards to the horizontal risk retention requirements as well as the required disclosures. Why don't we start there?
Yes, as promised, we're going to talk a little bit about fair value, and as been mentioned a number of times in the prior panels, generally the risk retention rules require that a sponsor of a securitization retain at least 5% of the fair value of all of the ABS interest issued in the same securitization transaction. And the fair value determination doesn't apply in the case of vertical risk retention because by definition the regulators felt that if you had 5% of the cash flows of every tranche, you have 5% of the fair value. The other exception is for revolving pool securitizations using the seller's interest option. In that case, fair value is also not required. It would be just 5% of the receivables essentially. So when does fair value apply? It applies when you are using the eligible horizontal residual interest option, which is the most subordinated class in terms of cash flows and absorbing losses. And the first thing I'm going to talk about is the disclosures required when you're using fair value. Sorry about that. There are two times when disclosure is required. The first is sponsor must disclose to potential investors a reasonable period of time prior to the sale the fair value of the eligible horizontal residual interest that the sponsor expects to retain at closing. And that's both in terms of dollar amount and the percentage that interest bears to all of the ABS interest issued in the securitization. So you can see that the sponsor not only has to determine the fair value of what it is going to retain, but also the fair value of all of the interest issued in the securitization. If the sponsor doesn't know the specific prices, sizes, or rates of interest, which it will not, obviously of each tranche of ABS, the sponsor can disclose a range of expected fair values based on a bona fide estimate of the expected prices, tranche sizes, and interest rates. And if disclosing a range of values, the sponsor has to disclose the method by which it determined any ranges of prices and interest rates. The disclosure must also include a description of the valuation methodology and all key inputs and assumptions, or a comprehensive description of such key inputs and assumptions, including, so this is at a minimum, discount rates and the basis of any forward flow interest rates used, loss given default, default rates, and lag time between loss and recovery, prepayment rates, and if a description of the methodology includes any curves, a description of the methodology used to derive the curves, and then a summary description of reference data or other historical information used to develop the input. So it's not necessary to include all reference data, but at the least you need a summary description of the data. And then a reasonable period of time after closing, the sponsor must disclose the fair value using the actual prices and final tranche sizes. And to the extent that the valuation methodology or any key inputs or assumptions that were used to calculate fair value have changed from the pre-pricing disclosure, then the sponsor must determine the material differences between those methodologies. And I think once Neil is going to be talking to how you actually determine the fair value. I think on the slide I failed to put up earlier, had said that the fair value is going to be determined using a fair value methodology under U.S. GAAP, and Neil will be addressing that.
Great, thank you. So as mentioned previously, under the rule, there's two concepts that have GAAP connotation: the majority-owned affiliate, which has to meet that definition, in addition to fair market value. And I think, Jeb, you had queued up the question in the last panel. So Neil, if you can actually tell us what it means under GAAP for fair market value. Let's start there.
Great. Yeah. So as Julie just mentioned, the regulation actually references a fair value measurement framework under GAAP. And so what does that actually mean? GAAP requires fair value in a number of circumstances. Many standards reference to fair value, but there is one standard, and it's called Topic 820. You might hear FAS 157 thrown around. That was the old reference, but Topic 820 has a uniform definition of fair value, and that definition is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Now, that's a fairly brief sentence, but behind that sentence there are many, many pages of interpretation on what that actually means, and I'm just going to go through some of the more important aspects of what that single sentence definition means. So if we go to our next slide, we have some of the key concepts around fair value. So number one, it has to be an exit price that you're looking to. So that's a price received to sell an asset or paid to transfer a liability. Not an entry price, not another type of concept, just an exit price. It also has to be the price that you would receive in the principal, or if you cannot identify your principal market, maybe you have more than one market that you transact in, the most advantageous market that's available. So that's an important concept as well. It also makes reference to what market participants view as fair value, not what you as an issuer that is assessing fair value, not what you think fair value is for yourself. You're looking to what other market participants feel as fair value. Also references to an orderly or active market. So if there is a distressed sale or forced liquidation price that's out there, that's not something you'd look at. So you look at what the price would be in an orderly or active market. Measurement date is pretty self-explanatory. It's the date at which the the financial statements are issued. So that's what you're looking at as your measurement date. And then we'll talk about valuation techniques. Under the standard, there are three approaches that are identified, and really you can have you can use one of these approaches to determining fair value, or a combination of approaches. And I think for securitizations, the typical approaches are going to be the market approach, which is a technique that uses prices and other relevant information generated by market transactions involving identical or comparable assets or liabilities, or the income approach, which is a technique that converts future amounts, cash flows, or income or expenses to a current amount that is a discounted amount. So really the income approach is really describing a discounted cash flow type of approach. So then coming to, I think what everyone, at least in the accounting world, thinks of when they hear the term fair value measurement framework, they think of the fair value hierarchy. And this is where we have the level 1, 2, and 3 elements of that hierarchy. So what do these terms mean? So level 1 refers to quoted prices in active markets for identical assets or liabilities that the reporting entity can access at the measurement date. Now, that generally means if you're talking about, let's say, an equity security, if it's quoted, say shares of Microsoft or Apple, that would be, a typical level 1 type measurement. And level 1 is what you would default to, or is what you would look to as being the highest level and sort of the most easily obtainable for those types of securities where it exists. Level 2 then is inputs other than quoted prices that are included in level 1 that are directly or that are observable for the asset liability either directly or indirectly. So what this really means is if you're using some sort of model to value instead of a direct quoted price, you use inputs that may be observable in the marketplace. So the classic example of a level 2 asset is like a plain vanilla interest rate swap. That typically, although it's using a model, a cash flow type model to value, the points on the interest rate curve are observable, and therefore that sort of qualifies as a level 2 of the fair value hierarchy. And then finally we come to level 3, which I think is going to be very relevant to identifying fair value for securitizations, is the unobservable inputs for the asset or liability. So that level 3 really means when you have a model that is using things that other than that can be identified, in the marketplace, and that gives, that's really a sort of a mark to model type of input. And I think we do have one question. I don't know if we have a mic. Okay.
I just wanted to confirm, if you decided to determine fair value on the basis of a third-party appraisal, where is that level 2 or is that level 3?
So a third-party appraisal, it could be, in theory, it could be any of the levels, but it's probably going to be in the level 3 most likely. But it really depends on what that third-party appraiser is looking at to determine the fair value. So if they're looking to, quoted prices, then really it's level 1. But if they're looking to sort of their own assessment and unobservable inputs, that's probably going to be in level 3.
If you were comparing sort of somebody doing their own model, figuring out their own, when the cash flows are going to come in, what expected losses are going to be, and so on, their own discount rate, and so on, and were to compare that to a third-party appraiser who'd be figuring out what the expected cash flows are, what the right discount rate is, which would be higher on the fair value hierarchy? Would it be the appraiser, or would it be the issuer just sort of doing their own thing, or would they be at the same place?
I don't think I don't think one is higher than the other. I think In that case, they're probably at the same level because again, they're looking at unobservable inputs, which could be, the issuer could have its set of unobservable inputs, and the appraiser could have its set of unobservable inputs. And so I think there's a kind of a tie there when you look at whether, what level they're in the fair value hierarchy, and they're probably in level 3. So
I would say, fair market value is not new. Some markets have been getting used to this over the past couple of years. I'll just mention when FASB issued 167, in which the CLO asset managers had to consolidate. All of them did the fair market value option for both the assets and the liabilities. So with regards to specifically equity, which is a horizontal, there is sort of a benchmark with regards to, I guess, people utilizing possibly a level 3, a model to mark. But understandably, there's other products or credits out there that really haven't gone through this. And I think that's sort of the vagueness with regards to sort of the T-minus December 24th happening in the market with all these questions as well.
And to just sort of build off of then taking level 3. So as we've discussed, this fair value measurement framework concept really comes into play only when you have a horizontal residual portion of a securitization, the 5%. And that's what the measurement of fair value comes into play. So if you look at the securitization structure overall, would be sort of the denominator in the calculation of the 5%. So that would be the total fair value as measured under this framework, and probably in level 3. And then you would look at the numerator of the calculation as being the portion that you're actually going to acquire, the residual horizontal proportion. And by doing the calculation of that over the total, you get to what percentage of the structure you would own. And as we know, it's a 5% minimum. So some of the questions that have come up has been around, well, how do we determine fair value for these structures and within the U.S. GAAP framework? And I think that what we've seen is that for hedge funds that hold or other funds, investment funds that hold CLOs in those funds, right now they're actually required to go out and figure out what a fair value is. And typically, again, it would be typically a level 3, but they would have models that they could do to figure out what that fair value is, or they might go out to other third parties, accounting firms such as KPMG, and would go out and get those third parties to help them determine what fair value is so that they can report that in their financial statements. So we think that, although it's a concept that certainly is, not necessarily as clear cut as finding out the share price of Microsoft, it's a concept that has been around for quite a while, as Nate mentioned, and funds are actually doing that already. So we think it is something that you can get, and we think that really there is not a real reason that we can see that a sponsor wouldn't be able to also go out and get either by themselves figure out a level 3 fair value measurement, or go out to a third party to get that measurement.
I'll just say one augmentation from doing the horizontal is you're going to have to get the fair market value of the whole capital structure. Whereas sort of in the CLO, the asset manager's really just looking for the fair market value in the CLO equity. This case, you're going to have to get all the inputs for the whole capital structure to do so, and value the whole capital structure.
By tranche?
Yes. Because you're going to have to do, like he said, basically it's 5% of the fair market value of all ABS interest, which is AAA down to the non-rated. So if you're at the bottom, you have to determine what your fair market value percentage, 5 or greater, based off the whole capital structure. And from what I was seeing, most people are sort of leaning to get more of the 5%, because if there's a variation in the market and you don't hit that bogey, most people are erring on the side of actually maintaining more than 5%.
Remember, I was saying that we had pre-pricing disclosure of what you expect to retain, and before you actually go out and sell the senior bonds, for example, you're not going to know the fair value of all of the tranches, so you don't know what 5% is until you actually price the other securities. So you need to have some way to right-size that, either by taking more of the horizontal interest, or there's another option to put additional funds in an eligible horizontal cash reserve account, but you may not know what 5% is until you price, or until closing, actually.
I think he's coming with the microphone, so thank you.
Thanks. If you have, for example, I'm an issuer. In my transactions, I have as my residual value a cash reserve account and excess spread. Normally, I am allowed by the rating agencies to take out that cash reserve over time based on performance. So when I'm valuing that part of my risk retention and doing my fair value, how do I account for that? Do I have to assume I keep it all in there or take it all out, or does it matter?
Well, there is an option to, rather than retain an eligible horizontal residual interest, to put the same dollar amount of that fair market value into a cash reserve account. But then there are restrictions on that cash reserve account. And
right. I don't want to do just the cash reserve account one, because that has too many. But I want to value it as part of my residual, my seller interest piece. Can't I do that?
You could include expected cash flow from the reserve account as part of the residual, but in that case, as you said, you're going to have to fair value that interest.
Right.
And, I
would say that you have to do it as determined under GAAP, not as determined by, the securities rating agency. So you'd have to determine that fair value on using the principles that we've outlined at a high level here.
Yeah, no, I'm just saying that the way that I have my cash structured is that I can release cash out of that cash reserve account.
I think she's saying that there's expected distributions in the same way you'd model expected cash flows. She's able to model expected distributions, and I would think that you'd fair value the expected cash flow in the same way.
I would think so.
But you don't have to keep the 5% beyond the day that you do the evaluation?
Not if you're not attempting to get credit for it as an eligible horizontal cash reserve account.
Right. Okay.
In which case, you wouldn't be fair valuing that. You would determine the fair value that you need at closing, put that dollar amount into the account.
Mm-hmm. Okay.
And then there would be restrictions on the release of the funds. But otherwise, as you said, you could include it as part of your residual.
Mm-hmm.
Any other thoughts or comments or questions? All right. I think the next panel will go into possible solutions around the requirements. Want to come up? Thank you.
Okay, excellent. You have the, okay.
Yeah, I have the clear.
So, so this last panel, we're going to talk a little bit about, you're going to try and do this transaction. Let's just use as an example that you want to raise capital and you're going to use the MOA vehicle. As part of the closing process, you're going to talk to your attorneys about what kinds of information they're going to provide that you are risk retention compliant. Because at the end of the day, it's your responsibility to verify everything that's in the offering memo, right? Baseline, that's kind of the way it is today. Nothing changes. So it's your requirement and responsibility to make sure that the offering memo is valid and everything you put in there is valid and supportable. So you're working with all of the parties involved, including bankers, lawyers, and accountants. And what we're dealing with right now is a lot of conversations about what kind of information can be provided by those advisors, what format, what I can rely upon, what I will get in writing, what I will get verbally, and so on. So this panel is going to talk a little bit about some of those types of situations, specifically focused right now on the lawyers and the accountants and what kinds of materials we believe we will be able to issue. One caveat, we're still early. There is not, for instance, in the accounting world, AICPA literature that's directly on point that would provide exactly what the accountants can do, who can rely upon it, what the format would be, and so on. So what Neil and I have been working on the accounting side is internally within our organization, what kinds of things will we be comfortable putting in writing, what would the format be, and so on and so forth. At the same time, there's a lot of industry groups that are getting together to try and talk about these issues and decide what these communications could look like. So there's Julie will tell you a little bit more about what's happened on the lawyer side, and Neil and I will tell you a little bit about what's happening on the accounting side. So why don't we start on the accounting side. So Neil, maybe you could start with just talking a little bit about what some of the types of advice that we as accountants are issuing as part of these transactions.
Sure. So as Dave mentioned, there's really a couple of areas where we're providing advice, and those relate principally to the term majority-owned affiliate, which in its definition in the risk retention rules refers to ownership of a controlling financial interest in the entity as determined under GAAP. And what does that mean? Well, earlier Dave talked about consolidation, and so controlling financial interest is really just a term of art. That means if an entity has a controlling financial interest in another entity, then that entity will consolidate that entity. So controlling financial interest, another way of reading this is just to say, will you consolidate a majority-owned affiliate? So that is one area that people are looking to accountants to understand what their responsibilities are. The other area, and there are other areas in the risk retention rules that do mention GAAP, but the other principal area is what we talked about before, which is fair value measurement framework under GAAP. I think in both cases, people are looking to accountants to sort of answer the questions of what those mean. We also know that, and Julie will talk more about it, lawyers have also been asked to talk about or possibly opine on risk retention, and so part of their procedures may be to get from accountants some of their views on these issues as well. So
Neil, one thing really quick on this slide, I wanted to highlight one thing.
Sure.
Before, when I talked about from a consolidation perspective, you had a parent, you had sub A and sub B. If you read these words very closely, I think I explained that poorly or wrongly. I think when you're thinking about this, it says right here, an entity other than an issuing entity that directly or indirectly majority controls, is majority controlled by, or is under common control with such person. So remember I was talking about how you might have to set up an entity, and sub B would have to put money into that entity, and sub A has to consolidate it. As long as there's a parent company up above that consolidates all of those entities, then you should be fine, and you probably won't have to do some of the structuring I was mentioning. So if Mass Mutual wants to put the money directly in, because that life insurance company is consolidated by Mass Mutual at the top, and the asset manager is consolidated by Mass Mutual, it's entities under common control, and you wouldn't have to do some of the structuring I mentioned. So I thought I wanted to make sure I provided that clarification to you. So sorry I interrupted.
Sure. Good clarification. So the first thing we're going to cover is controlling financial interest, definition again, which means to consolidate. So first, you may have the auditor be someone that you want to engage. You can either engage the auditor or a third-party accountant. If you engage the auditor, and when we say the auditor, we're referring to very strictly the auditor of the manager, because we've noticed in a lot of cases, and I think Dave mentioned this earlier, that the investment manager does not always, or the collateral manager does not always have audited financial statements. So but they may have funds that are audited, and therefore, when we say engaging the auditor, we're really talking about, strictly speaking, the auditor of the collateral manager. So in that case, you can engage. Some audit firms have been willing to issue a letter from their typically the engagement partner on the audit, and that letter essentially tells the firm whether or not there is a controlling financial interest, and therefore whether or not the MOA is consolidated, and that gives you comfort over whether that aspect of the rules, the definition that's contained in the rules, has been complied with. In a very similar way, but a little bit different because of some of the different professional standards that we as accountants are required to follow, when you hire someone who is not your auditor to do a similar type of reporting, we issue a report on the application of accounting principles, which again describes whether or not there is a controlling financial interest held by the collateral manager. So really the end result of the two different types of opinions are very similar. The one, when you use the auditor, is typically more of a letter signed by the audit partner to the collateral manager, and when it's engaging a third-party accountant, it's more of what we would consider to be a report signed by the firm and not by an individual partner. But at the end of the day, what the two letters are saying is pretty close to the same thing. One thing just to mention on those types of letters is that they are generally restricted reports, meaning that they can't be shared with parties outside of the collateral manager. However, what usually happens is there's a process that's put in place to allow certain parties to view the letter as long as they agree to sign a release. And so the auditors typically would be able to view the letter. The attorneys would be able to view the letter. And then, again, provided they sign a release, other parties could also be eligible to look at the letter but not place reliance on the letter. But really the point of the letter or report is to give the collateral manager firm comfort that they have been in compliance with these rules. And then I just wanted to mention one other thing quickly was also, so I've been talking mostly about majority-owned affiliate and whether it has a controlling financial interest in a majority-owned affiliate. There's also the issue of fair value measurement framework. I don't think we haven't seen as much action on that path, but we are certainly aware of many situations where such opinions on fair value have been issued by accounting firms. And so we're not really seeing, anything right now that would prevent a firm from issuing an opinion on fair value measurement under GAAP, but I just wanted to sort of make that point as well.
So a couple of things just to add to what Neil was talking about. We're seeing a lot of activity here in terms of conversation. We haven't seen a lot of the letters issued. We have some situations where they're just not required because the entity that is the sponsor also already has the capital. So there's no new consolidation issue that exists. So there's no letter that's required there. In those situations where there is an MOA and there is a requirement for a letter, it usually is driven by or directed by some aspect of the overall group of people putting the deal together. So it might be that the attorneys believe that it would be important for them in their provision of legal advice that this is in the risk retention compliant, that they want to see something from the manager. The manager may or may not have the capacity and the ability to write that letter internally, and that might not be enough for the lawyers or for the investors. Maybe the investor, as part of the negotiation on that party or parties that are putting in the money into the MOA, maybe they are demanding some kind of a letter. And one of the important things is the reliance that Neil was talking about, and it's as well who they can show the letter to. Most of these letters, as you can imagine, just like any legal opinion, is usually written for the party that has been contracted to provide that advice, accounting or legal, and therefore there's going to be restrictions. So the ability to give it to somebody else has largely been the conversation that's occurred. The letters themselves are fairly straightforward. They start with an introduction that talks about the structure, the transaction, the parties involved, the contractual provisions, and things like that, and a description. Then it goes on and it applies the accounting literature, and then it has the restrictions at the end as to who can see it, who can be provided with that information. So a lot of what we're still working out, and there are industry groups, there's a group convened by the AICPA to look into this particular issue and determine what kinds of letters can be issued. In the meantime, there are letters that are going out, and those letters are using the existing literature, but whether or not there are changes that happen because of AICPA activities remains to be seen. On the point about the fair value, that's a little bit harder. Right now, there are valuation reports that exist generally. If you do an M&A transaction and you buy a company, there's a lot of people who will hire an outside service provider to provide that opinion, that fair value amount, that report to document, for instance, the fair value of a particular intangible. That happens now in the M&A world a lot. The question is, nobody else really sees that. The auditors will see it in auditing that. Generally, they're allowed to see that. But third parties are not usually going to see that. In other words, there's usually not a third party investor into that entity that says, hey, I own 10% of you. You just did a business combination. I want to see the valuation report that you got to book that number. It just doesn't happen. So those reports are not set up for a wider distribution. So when we get to this position where somebody involved in the deal comes to the manager and says, I want to see your valuation report over those securities that you used in putting together disclosures in the OM, in that situation, usually that reporting isn't really set up for that. So is there a report that could be set up, that could be relied upon by others? Things like an agreed upon procedures report, some of the Reg AB reporting is allowed to be shared. So some of those things are what's being discussed, or what are being discussed right now amongst the Big Four and some of the industry groups to figure out what could be issued. So let's take a couple questions and then we'll come back, Julie, and do the legal side of it. Yeah, Stuart?
So just to be clear, as Neil said, there doesn't appear to be anything in the AICPA auditing guidance that would stop you from doing some kind of a letter saying you got fair value to the issuer, the fair value calculation is in accordance with GAAP. Is that something that you guys are in fact willing and interested in doing as in fact, a revenue generating opportunity?
Certainly we're looking at it, and we would love the opportunity, but whether or not the firms will be willing to take on that risk and whether or not the industry is going to be in a position to do that, we don't know yet. It's still early on.
And is the holdup sort of the firm's own internal risk management, or is there some AICPA blessing that you would all need in order to go ahead and do that?
Yes, it's both. I think there's still some discussion with within AICPA groups about that, and then there are discussions that are going on within the firms themselves as well. But at this point in time, I have not had a client who's asked me to provide any of that reporting yet. We have had clients engaged on the side of providing the accounting opinion, but we haven't had a request for the fair value opinion, not formally yet. Yes.
Assuming you come to a fair analysis of what the value of that residual is on day one, what kind of ongoing reporting needs to be provided as prepayment rates, loss rates, et cetera, differ from what the original assumptions were?
Good question. I think, Julie, do you have I think that's more of a legal question. Would there be any additional reporting after the initial date?
Not in a typical horizontal interest. There are some examples under the rule where ongoing fair value would be required. And one of those, for example, is if you wanted to get credit for excess spread in, say, revolving master trust requires some ongoing determination of the fair value of that interest.
Okay. Any other questions right now? Okay, let's turn to the legal side. Maybe, Julie, can you talk a little bit about, do you expect legal opinions with respect to compliance with risk retention to be requested from the law firms? And do you think the law firms will be willing or even able to deliver such opinions?
Well, as you said earlier, Dave, I think sponsors are just starting to really think concretely about the type of process they need for their risk retention solution and starting to ask themselves, will I want a legal opinion from my law firms, and am I going to be asked to deliver legal opinions to other parties in the transactions, for example, the investors or the underwriters or initial purchasers. And it wouldn't surprise me that many sponsors are going to seek legal assurance from their own law firms as to compliance with risk retention, whether that takes the form of a legal opinion or a more informal memo. And I fully expect that law firms have been and will be delivering that type of legal assurance to their own clients. What seems to be a harder question for law firms is whether similar legal advice can be delivered to the third parties in the transaction, particularly the underwriters in term securitizations. So based on my discussions on industry calls and informally with lawyers at my own firm and other law firms, lawyers are finding legal opinions to be delivered to third parties problematic for a couple of reasons. And the first is that risk retention is just a new area of law, and there are a number of interpretive issues under the rules for which we have either no regulatory guidance or very informal regulatory guidance. Should back up and say, generally a legal opinion expresses a law firm's professional judgment as to how the highest court in a jurisdiction would interpret the rules. And for risk retention, there are no such judicial decisions. There's no formal regulatory guidance, so it makes delivering a legal opinion more difficult. The second issue that law firms are facing is that compliance with risk retention depends in many respects on factual assumptions, and as we've been talking about for the past couple of hours, a number of accounting determinations that are outside of the usual scope of a legal opinion. And one example, leaving aside accounting, would be on the disclosure items that I mentioned earlier. For example, part of compliance is knowing that you've disclosed all key inputs and assumptions for your fair value determination. And is it a lawyer's purview to say what is a key input and an assumption? So by necessity, I think any legal opinion is going to have a lot of assumptions, effect, and accounting determinations. And law firms are asking themselves, in an area where you have very little guidance as to customary language for an opinion, customary assumptions, and general market acceptance of what might be appropriate diligence for those assumptions. Is it appropriate for us to give an opinion? And is it the type of opinion that would be very useful to the recipient? So given that those opinions are probably difficult to give and therefore expensive, I think we're seeing a natural pushback from both sponsors and law firms about delivering those opinions. And they're asking themselves, why does a particular third party need a legal opinion? So it's important to keep in mind that for U.S. risk retention, the compliance burden is on the sponsor. And there's no obligation on the part of investors or other counterparties to comply with risk retention. So the question is, do third parties need legal opinions? And I expect that at the very least, underwriters and initial purchasers, parties who have the need for a due diligence defense, are going to want a legal opinion. But I think whether legal opinions are ultimately delivered in the marketplace is, to go back to what Dave said, still very developing, and there is no answer on that yet. I think we're going to see how it plays out after the majority of asset classes are subject to risk retention at the end of the year. I think RMBS just isn't a big enough pool of deals to really establish the market on this point yet. Sorry, slide. Lastly, I wanted to mention that the American Bar Association has a joint task force of the Structured Finance Committee and the Opinion Committee that has been discussing these issues and has started to there's been an emerging consensus of that task force on a couple of points that I'll mention. First, that they don't believe that a no violation of law opinion is appropriate to give on risk retention. In other words, no opinion that a deal affirmatively complies with risk retention. However, the task force recognizes that for initial purchasers and underwriters, that the negative assurance letter should still cover the disclosures around risk retention. So keeping in mind, as we said in the earlier panel, there are a number of required disclosures. I talked about disclosures relating to fair value, but there are other required disclosure items generally for risk retention. And I'm going to back up for a minute for the non-lawyers in the room, which is, I think, the majority of you, just to maybe remind you of the difference between a legal opinion and a negative assurance letter. A negative assurance letter just says that nothing's come to the attention of the counsel that caused them to believe that the disclosures contain any untrue statement of material fact or omit to state a material fact necessary to make the statements in the disclosure not misleading in light of the circumstances in which they were made. So it's a very different standard between giving an affirmative legal opinion that the deal complies with risk retention and saying nothing's come to our attention that makes us think that disclosure is misleading. So again, task force is pointing out in the white paper they've put out that this position on opinions and negative assurance doesn't rule out written advice and memos given to clients. Really, I think the debate here is what will be delivered to third parties.
Excellent. So we try to just give you an overview of the accounting and the legal opinions that may be issued, might be available, might be required or asked for as part of this. It's still very, very early. We are still working through a lot of that. There are the groups that are getting together on a regular basis to discuss this. There's a group, an industry group right now putting together a handbook that will go through a lot of these issues that will be issued to their, it's the SFIG, is that the group that's putting that together right now? The,
Yes.
So
are you talking about the interpretive guide for risk retention?
Yes.
Yes.
Yeah, that's being put together by SFIG, so that will be issued to all members, and it's trying to go through and deal with a lot of these issues. So you'll see more guidance that way.
I would say we are targeting early fall. I should have mentioned I am kind of leading the SFIG effort on drafting the risk retention guide, and the first installment of that guide actually came out last December. Ahead of the RMBS compliance date, and a second installment of the guide will hopefully be published in September, a couple months in advance of the compliance date for other asset classes.
Okay, excellent. Any questions from anybody on the on this part of it? There's one point I wanted to just mention very quickly, as it relates to other asset classes. This came up at the break from the earlier sessions. So I received the question, what happens when you are holding, when you do a typical securitization like we were referring to in maybe an asset class like auto loans, and you hold 100% of the residual? What happens from a consolidation perspective today is you're going to consolidate that so it all comes onto your balance sheet. One of the questions I got was, do I have any separate accounting for the residual that I own in that circumstance? And the answer is no. Just like today, when you consolidate that entity, the transferor and the trust that issues the securitization debt, that's consolidated together. When it is, if you're holding that residual eliminates in consolidation. So from the perspective of the consolidated set of GAAP financial statements, there is no accounting for that residual security. However, in an instance where you have an MOA entity, to clarify what I said before, if that MOA entity that holds the retention security, so if you go into a situation in an auto loan securitization where you don't want to hold all the residual, you do believe there's somebody who wants to buy that economics, and you want to raise capital so that you can get them to help funding, then when you set up that MOA, many times it creates a new accounting or audited set of financials at that MOA level. If you then have separate standalone financial statements at the MOA level where that security has to be accounted for, then in issuing that report, you have to go through and figure out the accounting for that CLO or that residual in the auto loan securitization. When you go back up to the top entity that consolidates the MOA, and the MOA consolidates the securitization trust, then in that circumstance, the accounting for that security again goes away because it all gets consolidated. It gets eliminated in consolidation. So it's only in those standalone financials you may need for the MOA. Now, how do you avoid having to do that accounting for that security? All you have to do is negotiate with the investor that audited financials are not needed. Because usually it's that third party who's going to say in the negotiations, I'll put the money in, but I need to see audited financials for what happens with that money. If you can negotiate into, I won't give you standalone financials for the MOA, but I will give you standalone financials for the manager who consolidates the MOA, who consolidates the securitization trust. You may have a negotiating point there, and you may be able to get out of any audited financial statement requirement at the MOA level. Does that make sense? It's a bit difficult. For accountants, it's easy. We all understand when you start doing consolidated financials, it makes sense. But I think for those that aren't used to consolidated financials, sometimes that can be confusing. So I thought I wanted to clarify that. Okay, any final questions for any of us up here? Yes. Hold on, the mic's coming.
Cover this, but for the vertical option, there's an option to combine all the pieces into one note, or one security, I should say. I'm struggling to, if you have a note and a certificate, traditionally you have your notes and your certificate, and you combine that all into one, including the certificates, doesn't that bring in further complications for accounting, and you kind of have a hybrid? I guess I'm not used to seeing a certificate and a note combined. what are your thoughts on that? Has anyone started to think through that road, and if you're, what that would look like?
From an accounting perspective, you're going to have a security. If you have to do separate, so I'll go back to what I just said. If it's in a situation where you consolidate the entity that holds this, it might eliminate.
Yeah, let's assume it's not consolidated. So it's the 5% vertical slice on your books.
Yep.
And it's all combined into one security.
So if you don't consolidate the issuing entity that issues that vertical one security vertical strip, then in that situation, your first question is, do I have an equity security under current GAAP? Do you have an equity security or a debt security? If it's a debt security, then it's in the legal form of, and there's a definition in GAAP as to what a debt security is. It's largely going to be driven off of what's the legal nature of it. If the legal nature of it is a debt security, then the accounting's the reporting's pretty easy. You're going to be in FAS 115. You're going to have trading, AFS, or held to maturity for that security. So you could elect fair value, or you could do an accounting that would be more like an AFS security. Or if you tried to do held to maturity, you're probably, you're going to have a stated coupon for that, I would assume.
Well, that's where the issue comes, I guess, is that if you had a note and a certificate separate, the note would be treated one way from an accounting perspective and their certificate a different way.
Could be. They could both be debt
So certificates don't know, like in an auto securitization, right, where you have the residual, there wouldn't be on a certificate, you'd go into more IO strip type accounting where there's not a stated coupon.
Correct.
I guess that's what I'm trying to struggle with is how do you combine that certificate into a note? Even from a legal standpoint, they've always been different legal documents for their notes and their certificates. How does just the vertical slice then combine those things that have always been separate?
Right. So I think you've got two questions there. One is accounting, one's legal.
Yeah.
I probably have failed in trying to describe the accounting. Do you have a reation on the legal side as to what that security looks like?
I'm not sure if you are asking. I do know what that security looks like. I think it, whether it's debt or equity, I don't think it is the legal question.
So there's
it's essentially a security that's entitled to 5% of the cash flows of every tranche. So it is a security with that right to the cash flows.
So it's just a place. To me, it's a place in the cash flow waterfall, and it's just a description of where you get those cash flows that then flows into a security form.
Yeah. So then it's probably more of an accounting issue.
So then
maybe that's a little bit of a hybrid.
So then if we get into an accounting issue, if it has a stated coupon rate, then you would probably follow, again, it depends. Are you going to do fair value or not? If you're going to do fair value accounting straight up, then there's no issues in terms of income recognition. Mm-hmm. If you're going to do AFS, or available for sale, where you're going to mark the security to market with the mark going in OCI, and then you're recording your yield separately on the income statement. In calculating the yield, we probably would push you towards a 99-20, kind of what you said. How do you calculate the yield when you have an IO strip? You're going to follow that EITF 99-20 type of a model is likely where we'd go. Okay. Obviously, if it's not clear, we haven't had a ton of discussions about that yet.
Yeah, no, I think the hard part for me is that there's not going to, you can't have a stated, I don't understand how you have a stated rate for the whole thing. A note you would, but a certificate doesn't. So even when we combine it from a legal sense, you'd say I guess you'd just say 5% of all the cash, but that would result, it wouldn't have a stated.
Okay. So
do you agree, right? It probably wouldn't have a stated
So
rate.
If you don't have a stated rate, then I think you're going to follow a 99-20 type of an effective yield model.
I agree.
I would guess that would be the case.
Okay, thanks.
We haven't really got into the details yet. I guess my point is there's a lot of technology that's out there for various different kinds of securities, and we're going to fit it into one of those or some hybrid of that. But I don't think we've got into a lot of those details yet.
Okay, thanks.
Sure. Yes, one question over here.
Just going back to your asset classes, so you see the RMBSs are exempt, like the GSE securitizations. With the CMBSs that are like part of the DUS program, are those in scope, or would they also be exempt?
Julie, do you know?
No, but I'm guessing Eric behind you might be able to answer the CMBS question.
Maybe you could hand him the mic.
To the agency product,
Mm-hmm.
I think it is, but I'm not 100% sure.
You think it is exempt?
Yeah, I'm not
Okay.
100% sure though, because it follows along the same line as QM and
Mm-hmm.
guaranteed. So
Okay.
I have to double check.
Okay.
Fannie,
Mm-hmm. Yeah, multifamily. Yeah.
Okay, for those on just watching the video, the question was, is there a qualified commercial mortgage-backed securitization that would be exempt? And the answer is, we think there may be, but that's something to follow up on with your attorneys. Okay, any other questions? If not, thank you everybody for coming today. We appreciate it. We're still in the early stages of this. We're still working through a lot of this. Any of us in the industry are constantly on calls trying to talk about how we are receptive to information requests and the like. We hope that we provided you some information today. We are going to have a cocktail session afterwards here, so please do stay around for a little while. And thanks again for coming.
Thank you, everyone.
Thanks.